I want to put to you the question that Tim just asked Maria Clara. Are we in a period where we're seeing a shakeout of the digital asset treasury space, where you've got some survivors and everyone else kind of needs to figure out what their purpose is?
Yeah, it is still early days for the overall, what you call DAT ecosystem. Most importantly, I do think it's working in the instances of both strategy and strive. And you might say, how is it working? Your stocks are underperforming Bitcoin. And I would say that is by design. That is a feature, not a bug. Our common equities are designed to amplify Bitcoin exposure. Right now, you mentioned Bitcoin's at $62,000. That is literally at the 200-week moving average, which historically has marked near the end of a Bitcoin bear market. I think the underlying fundamentals of Bitcoin are strong, probably never been stronger. And so amplified Bitcoin exposure is great. Strive has been buying Bitcoin hand over fist in the midst of this bear market. You have up here, we have almost 20,000 Bitcoin. Remember, last fall, we had 5,000 Bitcoin. We've almost 4x'd our Bitcoin's holdings. Our digital credit product is working really well, and I'm looking forward to probably talking about that with you also today.
Yeah, we're going to talk about that in a few minutes. Before we get to that, though, Matt, more on the bigger picture, because treasury companies, Bitcoin treasury companies, have lost around $62 billion in market cap going back to October of last year. That's when we saw the peak, at least in this cycle, for Bitcoin. Reserve One, we just spoke about it just now, down 90%. You've said consolidation is coming. Only a handful survive. Are you the consolidator, or could you be consolidated?
So I think it's almost impossible to imagine us being consolidated right now. Our strategy is working really well. When it comes to some of the other players, I've been out publicly saying I don't think Strive is likely to be a consolidator. And the reason is that our strategy is actually working so well. In the last month, we've announced Bitcoin buys on single weeks of over 2,000, over 1,000 this last week, over 700. You combine that and you're getting close to $4,000 to $5,000 Bitcoin buys in just a month. Look down the list of Bitcoin treasury companies, how many Bitcoin they own. Our own strategy is working faster than accumulation could do. And so while I do still think that Bitcoin treasury companies teaming up would make for stronger instances, I don't think that Strive needs to be a consolidator at this moment.
Okay, how many of the companies in the digital asset treasury landscape are dead men walking then at this point?
Dead man walking is probably too strong of a term, but have not proven a sustainable strategy. I would agree with that assessment of the broader ecosystem. And so whether they go down the route of an operating company, which is what you're seeing with Jack Mallers in 21 and still in the early days of building that out, or whether you're seeing a pure play amplified Bitcoin digital credit company with like Strategy and Strive, you have a few more players in the international markets that are looking to do similar. I think it's still early. So I think that a few of them will likely age poorly. I think a few of them will figure it out. And obviously it's never easy when you start a new industry of an explosion of Bitcoin treasury companies right into a Bitcoin bear market. But I think that will separate the strongest from the weakest. And it kind of gets back to the point of Strive. I mean, we 4x'd our Bitcoin holdings in the midst of it operating in a Bitcoin bear market. To me, that's strength. I look forward to see what we can do in a bull market.
Matt, I want to talk about credit. As we were, sort of teasing earlier, you argue that digital credit represents the next biggest story in Bitcoin. What is that story, and why is it such an opportunity?
Yeah, it's really simple. So right now we live in a fiat-denominated world. The dollar is still the reserve currency of the world. My view and the view of several Bitcoiners is we're moving to a Bitcoin future. That future is likely to move towards there over the course of the next several decades. Digital credit provides a double-digit income based on Bitcoin risk. And it's a great time to talk about this because last week was the toughest week in the short history. Digital credit's only been around for a year, but the toughest week in the short history of digital credit. But even in the midst of that short history, the total returns for digital credit, so STRC from Strategy, SETA from Strive, STRC's total return since inception, if you bought it at 100, has been slightly negative. SETA's been positive in the midst of a 50% drawdown in Bitcoin. You compare that versus treasuries. Take TLT as an example, the largest treasury ETF. For the last 6 years, it's had a negative total return of about 25%, minus 4% on average per year. Digital credit's outperforming that in the midst of a massive Bitcoin bear market, and I think it's going to work, and I think it's going to be a $1 trillion opportunity.
Well, you mentioned the toughest week that you've had in this really nascent asset class, I guess we can call it, only a year old. We're talking about STRC, strategies perpetual preferred stock, just hitting that record low at $89. If the market is stress testing digital credit right now, what makes SATA different from STRC?
Yeah, so they're very similar. There's two differences with SATA that I would highlight. First, SATA is the first listed security in U.S. capital markets history to pay a daily dividend. That is true innovation. Even money markets, as an example, they accrue interest. They pay about once a month. So paying a daily dividend substantially reduces the volatility. And then secondarily, Strive has been more stable in maintaining a cash reserve. So when we IPO'd SATA in November, we started with a 12-month reserve. We now have an 18-month reserve in the midst of a bear market. And so we could literally do nothing until, I'll call it, the end of 2027, not have to sell a single Bitcoin. That is balance sheet strength, and it allows our common equity to underwrite in an appropriate risk manner a long, amplified Bitcoin exposure. And so those are the two primary differences. But I think from the broader market's perspective, I think the risk of both of these is mispriced, and the income opportunity is great.
Matt, let me ask you a basic question. What practical solutions does digital credit provide? How would companies use it? How would individuals use it?
So my view is income as a asset class is broken in the broader capital markets. We talked about TLT, how the returns of U.S. Treasuries, I think, are fundamentally broken. Money markets, as an example, money markets don't even keep pace with the rate of fiat currency debasement, which is average 6 to 7% per year. And so the money is broken, the dollar is broken, and people are losing trust in income solutions. We had a 40-year bull run in U.S. Treasuries from 1980 to 2020. That propped up fixed income returns. That is not going to be the case for the next 40 years. And so people need high income. We have a retirement crisis in this country. And so whether you're an income, whether you're an individual, whether you're a corporation, you need something that returns greater than the rate of fiat currency debasement and backed by a strong foundational asset. And that is what digital credit provides. And I think this stress test in the midst of a Bitcoin bear market, if you think about when Bitcoin comes out of a bear market, it's pretty obvious to me that the credit risk tied to Bitcoin will come down, and that these will be very attractive securities for a lot of people and a lot of corporations.
I mean, you've said that digital credit will be bigger than spot ETFs, could become a $3 trillion market. The entire digital credit universe, though, is these two products, SATA and STRC. How do you get from these two products to $3 trillion in assets?
So my view, just to be a little more precise there, I think the ETFs around Bitcoin are going to also expand drastically, but there is just such a massive need for income in this country and around the globe that credit markets are massive, and there's a reason for that. There's a reason that these are broken. So how do you get to that point? We're going to likely see several new issuers of digital credit instruments. We're going to see ones tied to the pound, one that's tied to the euro, one's tied to the yen. And then in the US capital markets, which is obviously the deepest capital markets in all of the world, you're going to see different risk return profiles. So some companies take less amplification, pay less yield. Strive's taken the opposite approach. We are very optimistic on Bitcoin's future, and so we're taking more amplification into our common equity, paying a higher yield on SATA, and then backing that with a sustainable, well-communicated cash reserves. And so I think this could be really, really large. And so the fact that we've seen it explode to about $10 billion in the midst of a bear market, I think shows you what this could be in good times. And I think as it's in good times, as track records are developed, and I think these track records are developing very strongly, you're going to continue to see growth in digital credit.